Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Uh, we are going to talk about the statement of cash flows. We are currently in week 8 of an 8-week course. This is the final chapter of this course. The discussions on the statement of cash flows. As a reminder, what's happening this week, you have a Chapter 15 quiz, a Chapter 16 quiz, and the final exam. This is the final week of the course. So by this Sunday night, you must complete and submit the Chapter 15 quiz, Chapter 16 quiz, and the final exam, all within the next 5 days. Okay. Everything must, and I repeat, must be submitted by Sunday night. I will not accept anything past Sunday night. Will not. That is a university policy, and I must have your final grade submitted to the university on Monday. Okay, that's why, just so you understand. Okay, let's go ahead and jump into our discussion on the statement of cash flows. The statement of cash flows, as I had said, is the fourth financial statement in accounting. We have the first one is the income statement. Everything starts with the income statement. You got your income statement, you have your balance sheet, you have your statement of retained earnings, and the fourth is the statement of cash flows. Here's the difference, okay? The income statement represents your revenue and your expenses and your net income. The net income is being the end of it's your revenue minus your expenses, net income, right? That's your income statement. On your balance sheet, you have assets, liabilities, and equity. And on the statement of retained earnings, you have retained earnings, which is formulated by net income minus dividends equals retained earnings. And then you have beginning balance retained earnings plus net income minus dividends equals retained earnings. The fourth statement is the statement of cash flows. The statement of cash flows represents all of the actual cash, the cash coming into and out of the business. Cash inflow minus cash outflow equals net cash flow. And there are three primary reasons why cash comes into and out of the business. And we're going to talk about those activities for the uses of cash and why we receive cash, why we pay cash. Cash is used in three primary areas of business. We have operating activities, investing activities, and financing activities. In operating activities, which is the first thing we're going to talk about, is the cash we receive from our customers from sales. That's the cash inflow. And the cash outflow is all of our expenses. We call it operating activities because it represents the day-to-day operations of the business. So when you hear operating activities, think day-to-day operations of the business. We receive cash from our customers from the sale of goods and services, whether we receive it at the time the good or service is delivered or as a form of accounts receivable later on, right? That's cash coming into the business. That's cash inflow. Cash inflow. The cash comes out of the business when we're paying our day-to-day expenses. We're paying our utility bills, we're paying our employees, we're paying our taxes, we're paying our whatever else, right? The list goes on and on. We're purchasing supplies, cash going out of the business. Cash comes in the business from the sale of goods and services to our customers. It's either at the time of the sale or it's later on through accounts receivable. And cash goes out of the business when we pay for our expenses. So cash coming in is called cash inflow. Cash going out is called cash outflow. The cash inflow minus cash outflow equals net cash flow. That's the difference between the cash coming in and the cash going out. Why is it important to understand cash flow? Well, the simple reason is because we need to make sure the company has enough cash to pay its debts. So I look at the timing of cash coming in and out of the business based off of our day-to-day operations to plan our day-to-day operations, to know when I should be paying my bills, to understand the company's ability to pursue unexpected opportunities or to make long-term investments. Understanding the cash flow is a critical part of business. You got to know how much cash is coming in and leaving the business. Okay? Because if you don't know that simple thing, when cash is coming in, cash going out of the business, you could go out of business, right? You go bankrupt. Because if you don't have enough cash on hand to pay your debts, you might as well go out of business now, right? That's why cash flow is so important to understand. And that's why it's its own financial statement. How do we measure the cash coming in and out of the business? We look at this thing called cash equivalence. Cash equivalence is cash and things I can quickly convert into cash. If I could quickly sell stocks and bonds to get cash, that is a cash equivalent. Something that I can quickly convert into cash is called a cash equivalent. An example of that would be selling stocks and bonds. Very quick, very easy. That's cash equivalents. So quickly convert to cash, that's cash equivalent. I will say this. Inventory cannot be quickly converted into cash. I can't just liquidate my inventory. Okay. Why is that? Because I don't have somebody right there willing to buy it. You know what I mean? So inventory cannot be quickly converted to cash, but stocks and bonds can. Now,
Okay, Professor.
yes, what?
Um, for bonds, I think it's a long-term investment, right?
It depends.
Oh,
You because and the reason why is you can sell those bonds. You can sell those bonds on the open market, on the bond market. So it could be short term. If it's short term if you decide to hold it for less than 12 months. It's long term if you decide to hold it for longer than 12 months.
okay.
Yeah. Good question. So that's one. That's why bonds and stocks are considered to be cash equivalents because we can quickly sell them. We can quickly convert those into cash, and that's over the open market. As we talk about the statement of cash flows, there are three primary reasons why we use cash. There's operating activities, investing activities, and financing activities. Operating activities are day-to-day operations of the business. Financing activities is the purchase or sale of property, plant, and equipment. And in financing activities is the acquisition or the payment of things like loans, stocks, and bonds. So on your statement of cash flows, you'll see these three sections: operating activities, investing activities, and financing activities. Operating activities, again, that's the day-to-day operations of the business. The cash coming in is from the sale of goods and services to our customers. The cash going out is us paying our expenses, paying wages, paying rent, paying utilities, paying whatever, purchasing more inventory. Those are day-to-day operations. So operating activities, day-to-day operations of the business. Investing activities is the purchase or sale of property, plant, and equipment. Those are investments in assets, fixed assets. So investing activities is the purchase or sale of property, plant, and equipment. Purchase or sale of property, plant, and equipment, that's investing activities on the statement of cash flows. Financing activities is taking out a loan, repaying a loan, stocks and bonds. So there's cash coming in and cash going out of the business. Cash inflows minus cash outflows equals net cash flow. Cash inflows for operating activities is the receipt of cash from our customers as a result of the sale of goods and services to our customers. Other cash inflows would include things like receiving cash from accounts receivable from our customers, receiving cash from interest revenue, or receiving cash as a result of dividend revenue from our investments. Cash outflows for operating activities would include things like paying wages, paying other operating expenses, paying our taxes, paying interest owed, paying suppliers for additional goods and services, etc. Cash inflows minus cash outflows equals net cash flow. For investing activities is the purchase or sale of property, plant, and equipment, and sometimes also intangible assets. And so that we have tangible and intangible. Tangible assets means I can physically touch it. I can physically touch the building. I can physically touch the equipment. I can physically touch the land. Those are tangible assets. Intangible assets would be things like trademark, goodwill, a patent. Those are intangible. I cannot physically touch them. They're ideas, right? So I could have cash coming in and out of the business for the purchase, sale of property, plant, and equipment, cash coming in and out of the business for related. So cash coming in from selling intangible, tangible, long-term investments, short-term investments, notes receivable. That's cash coming into the business for investing activities. Cash going out of the business for investing activities would be the purchase of property, plant, and equipment, intangible assets, repaying a loan, short-term investments, long-term investments. Financing activities is the issuance or repurchase of stocks and bonds and other debts. Cash coming into the business from financing activities would be the sale of treasury stock, the issuance of common and preferred stock, the issuance of bonds, the issuance of debt in the form of bonds, or cash or contributions from owners. In other words, the owner is putting in capital. Cash going out of the business for financing activities would be things like the payment of dividends to shareholders, purchase of treasury stock, owners taking cash out of the business for withdrawals, or to paying off short-term and long-term debt. So to recap, there are three primary categories on the income statement. On the statement of cash flows. Operating activities, which is the day-to-day operations of the business. Cash coming in from the sale of goods and services to customers. Cash going out for day-to-day expenses. We have investing activities, which is cash coming in from the sale of property, plant, and equipment, and cash going out from the purchase of property, plant, and equipment. Then we have financing activities. Cash coming in from issuance of stocks and bonds. Cash going out for the repayment of stocks and bonds or dividends. And we also have non-cash investing and financing. When cash is not involved, we typically record this in the form of notes on our financial statements. This would include things like the retirement of debt by issuing equity stock. In other words, I'm converting the debt into stock. Conversion of preferred stock to common stock. The lease of assets in a capital lease transaction. Purchase of long-term assets by issuing a note or a bond. The exchange of non-cash assets for other non-cash assets. Purchase of non-cash assets by issuing equity or debt. One of the earlier examples we talked about, as you may recall, and this would be, this would be more operating than anything else, but remember how we talked about the conversion of an accounts receivable to a note receivable? It's similar. Because there's no cash involved in that exchange, okay, in that conversion. So to prepare a statement of cash flows, we look at the cash coming into and out of the business for each category. Operating activities, investing activities, and financing activities. So cash coming in minus cash going out equals net cash flow. So cash coming into the business from the sale of goods and services to our customers minus the cash going out of the business for our day-to-day expenses equals our net cash flow for operating activities. And we do the same thing for investing activities. Cash coming into the business from the sale of property, plant, and equipment minus the cash going out of the business for the purchase of property, plant, and equipment equals the net cash flow for investing activities. And then we do the same thing for financing. Cash coming into the business from the issuance of stocks, bonds, and the like, and the cash going out of the business from the repayment of stocks, bonds, dividends, etc., equals the net cash flow for financing activities. We add our net cash flow for operating plus investing plus financing equals the increase in cash flow plus or minus the cash at the end of the prior year, depending on what it was at the end of the prior year, equals the cash and cash equivalents for the current period end. When we prepare to complete the statement of cash flows, we do it step by step. The first step is to compute the net increase or decrease in cash. Okay. How do we compute the net increase or decrease in cash? We go through the sales minus expenses, through that process. Yeah. That we just talked about. Step 2 is we compute the net cash flow from operating activities. Cash sales minus your expenses equals the net cash flow from operating activities. Step 3, we compute the net cash flow from investing activities. The sale of property, plant, and equipment minus the purchase of property, plant, and equipment equals net cash investing activities. Step 4, we compute the net cash flow from financing activities. The issuance of stocks and bonds minus the repayment of stocks and bonds, etc., equals financing activities. And the 5th step is to compute the net cash flows from all sources by adding the beginning cash flow to get the ending cash flow. It's important for businesses to understand their cash position at all times, as I had earlier said. The reason why it's important to understand that is the business needs to know if they have the ability to repay their debt. They also need to know if they have the ability to grow the business through investments, or if they have the ability to take on new investments from the issuance of stocks and bonds. The statement of cash flows tells us all of these things. So that's why it's important to analyze the cash account. The cash account tells us the story of what cash is coming into the business from and going out of the business for. And the cash account essentially creates the statement of cash flows. And there's another approach to understanding how to prepare the statement of cash flows, and that's by analyzing the non-cash accounts. So it's basically like saying, how do I know what happened with my cash, right? Like if I wasn't properly tracking my transactions, how do I know how much cash I got? Well, a way of calculating that is to take your total liabilities plus equity minus non-cash assets equals cash. How much cash you got? Liabilities plus equity minus non-cash assets equals how much cash you have. It's basically like rewriting the accounting equation by breaking out the non-cash assets from cash assets. So what kind of information do you need to prepare the statement of cash flows? Well, you need your information on your balance sheet. You need your information from your income statement and a little bit of additional information. There are two methods to creating the statement of cash flows. One is called the indirect method, and the other is called the direct method. The direct method is what we call direct. And this is just for the operating activities. For operating activities, the direct method is direct. We have cash coming in from our customers minus cash going out of the business for expenses like merchandise, wages, interest, taxes, to equal our net cash flow for operating activities. Cash inflow minus all of your cash outflows equals net cash flow. That's direct. Why is it direct? It's easy. It's straightforward. It tells us exactly what happened. And it's short. Short. It's easy to understand. The indirect method, on the other hand, is a little bit more complex. The indirect method takes into consideration net income. Net income comes from your income statement. At the very bottom of your income statement, we take that net income amount, and then we reconcile your net income to your operating activities through cash. Increase in accounts receivable gets subtracted from your net income, minus purchases of inventory, minus prepaid expenses, minus accounts payable, minus interest payable, plus income tax payable, plus depreciation expense, plus loss in the sale of plant asset, minus gain on retirement notes, equals net cash provided by operating activities. The reason why we call it the indirect method is because we use net income and we reconcile our cash transactions to the net income. But you see, what other method you use, you will derive the same exact net amount. Your net cash is the same, whether you use the direct method or the indirect method. Personally, I prefer the direct method because it's simpler, in my opinion. So using the indirect method, we take our net income and we reconcile it to our cash. Okay. So on our income statement, we see that our in this example, on our income statement, we see that our net income is $38,000, and we see that our cash balance is $17,000, and we have some additional information: purchase, sale, property, plant, equipment, et cetera, et cetera. We take all of that information and we start to adjust to our net income. So net income, $38,000. We take our the cash for depreciation. Take depreciation expense, loss on the sale of plant assets, gain on the retirement notes, and then we take our current assets and liabilities. Cash used. We have an increase in accounts receivable, increase in inventory, increase in prepaid expenses, decrease in accounts payable, decrease in interest payable, an increase in income tax payable to get us to our net cash flow of $20,000. That is the indirect method. The indirect method, again, very complex. It's a lot more difficult to compute, but it's more detailed in that regard, and it reconciles to the net income. That's why companies use the indirect method. But again, it's much simpler to use the direct method. Also, there, as you notice through the indirect method, there are adjustments for the income statement items that do not affect cash. Things like depreciation expense, loss in the sale of property, plant, and equipment, or the gain on the retirement of notes. expenses and losses without cash flows are added back into the net income. And revenues with no cash inflows are subtracted from that income. That's how the adjustments are made. And then, of course, the adjustments that we made on the indirect method also correlate with current assets and current liabilities. With current assets, we subtract from net income. If it's increasing, our current assets. If our current assets are decreasing, we add it to net income. For current liabilities, if the current liabilities are increasing, we add to net income. If they're decreasing, we subtract from net income. And this, of course, is all part of the indirect method. And that's the second step for computing it, using the indirect method. There's decrease in cash assets. We add to net income. We also add to net income when there's an increase in current liabilities. We increase current assets. If there's an increase in current assets, we subtract from net income. And if there's a decrease in current liabilities, we subtract from net income, using the indirect method. And after you have computed the operating items and the finance items, we get our net cash for operating activities using the indirect method. And again, the indirect method, it's the more complex method because it takes net income and we reconcile to net income using non-cash items. For investing and financing activities, it's a lot easier. And it's a three-step process. We identify investing related accounts, we look at their T accounts, and we report the cash flow effects. For investing and financing activities, it's easy because it's represented based off of what happened with respect to the assets and the equities. So long-term assets, we have property, plant, and equipment. The purchase of property, plant, and equipment increases property, plant, and equipment, which would be reflected on the statement of cash flows for investing. So in this example, our company purchased plant assets and built plant assets. We purchased plant assets, sold plant assets, and so through the purchase and sale of plant assets, we can get a net cash flow for our investing activities, which is what this shows here. And for financing activities, it works the same way. We identify finance-related accounts, match the T accounts, and report the cash flow effects. So for financing activities, we're looking at things like notes, stocks, and bonds. The notes, stocks, and bonds, if it's coming into the notes coming into the business, it's a debit to cash, credit to the notes payable. In this example, we're paying cash, so it would be debit notes payable, credit cash, and of course the difference. And that cash coming in minus cash going out equals net cash flow. And that's the simple formula that we follow for both investing and financing activities. It's simply the cash coming in minus the cash going out for those respective activities. And so we can also derive the retained earnings transactions from this as well. And how do we do that? We look at the analyzing retained earnings from the balance sheet. We subtract out cash dividends that are paid out, and we record the ending balance retained earnings. And the retained earnings ultimately part of financing. Using summary T accounts, we're looking at the ending balances, and we're looking at the effects of those balances on our cash. So in other words, you're just looking at the cash account, looking at cash coming in minus the cash going out for the related activities, and categorizing them based off of what they're used for. Ratios. You guys love ratios, don't you? I know you do. It's so important to understand some of these ratios. Understanding your cash, super important, because managers make decisions based off of cash flows at the time the cash comes into and out of the business. We evaluate the company's performance based off of those cash flows. And investors use that information on when to buy and sell stock. So that's why it's really important to analyze cash flow information. So one of the ratios that is most commonly used when we evaluate our cash flow is called the cash flow on total assets. And what this does is it helps to assess the company's performance as it relates to using cash. And to do that, we take our operating cash flows divided by average total assets. The operating cash flows is the net operating cash flows. So there'll be cash inflow for operating activities minus cash outflow for operating activities equals net cash flow for operating activities divided by average total assets. Most companies will use like a spreadsheet, or hopefully they'll use something like QuickBooks to generate the statement of cash flows. And this is a nice example of using a spreadsheet to help organize that information to prepare a statement of cash flows. But again, in today's modern age, most companies are using some type of accounting software to help them to generate things like the income statement, balance sheet, statement of cash flow, statement of retained earnings. And it's a lot more, it's easier for individuals to use those softwares in order to do the work for them. Because otherwise, let me tell you, I used to do this type of stuff for companies using Excel. Over time, it just gets confusing. So it's a lot better to use software. So we talked about the indirect method to a great length, reconciling the net income to the transactions for operating activities using non-cash items. The direct method, so much easier. We're taking the to do it using the direct method. We're taking our cash coming in from our customers minus our cash for payments for day-to-day operations equals the net cash flow. A lot easier. It's just a lot more straightforward to do the direct method. So cash coming in is from customers and which is sales, or for other reasons. It depends on what the primary operations of the business are. Rent coming into the business because your business owns a space and you rent it to others. Interest coming into the business from investments. Dividend revenue because the business owns percent ownership in other companies, whatever. And then we have payments for various reasons. to suppliers for cost of goods sold, operations, operating expenses. We're paying employees for them working for us for wages. We're paying interest. We're paying taxes, etc. Cash coming in minus cash going out equals net operating cash flows for day-to-day operations of the business. And that, my friends, is the conclusion of our statement of cash flows. Any questions at all on the statement of cash flows? There will be about 2 questions on the final exam for the statement of cash flows, just so you know. Go ahead, Mark.
I'm not ready to take the final. I just want can we do chapter 17? It's like, I'm just kidding.
We'll do 17 when we get to Principles of Accounting 2.
Oh, why can't we do chapter 17 in this class? I'm not ready for the final yet.
Sorry, buddy. Final exam, it's here. So, to recap, what's due Sunday night? Sunday night, Chapter 15 quiz, Chapter 16 quiz, and the final exam. Okay. Now, here's the thing. The last day of this course is October 17th. What that means is everything that you are required to submit for this course must, and I repeat the word must very strongly, must be submitted by October 17th. There are no exceptions. Nothing, and I mean nothing, will be accepted past October 17th, which is this Sunday night. So, if you have anything that's still due, it must be submitted by Sunday night. Sunday night is the last day I will accept anything for any reason. Okay, the last day. The university policy is very clear. Nothing can be accepted beyond the last day of class. Last day of class is October 17th. So if you still owe me something that's past due, guess what? It must be completed and submitted by October 17th, including the Chapter 15 quiz, Chapter 16 quiz, and the final exam. You got 3 things that are due in the next 5 days. My recommendation is start today, because that's a lot of work. Don't wait until Sunday to do these 3 things, because I promise you, you'll be overwhelmed. I don't like to be overwhelmed. I don't want you to be overwhelmed. I want your life to be a little easier. So please, complete all of your work by Sunday night. Take your time, but remember you only have 5 days. So I recommend you do Chapter 15 quiz today. Within the next 2 days, do Chapter 16. And then by Sunday night, you're doing the final exam. If you do it in that order, you'll be okay. Spread it out, but you only have 5 days to spread it out. So I would start today. Any comments, questions, or concerns? You're all right. Okay.
Professor,
Yes.
do you know if it's late to register for any class?
I'm sorry?
Do you know if it's late to register for any class?
Yes, it is.
Okay.
Yes. Yep. At least for the fall semester, yes.
Okay.
Registration, I believe.
Even if it's an 8-week course?
I'm sorry?
Even if it's 8-week course?
Yes, that's correct. Yep.
Okay.
Yeah, the registration window is only, I think, for like just before the semester and then a week after the semester starts.
Okay. Right.
Yep. Sorry. Go ahead, Gina.
So on next Tuesday we start accounting 2.
Yep. If you're in my accounting 2 class, we start accounting 2 next week.
Okay, cool.
Yeah. Isn't that fun? Cool. All right. Well, first and foremost, let me say thank you. I want to thank all of you for your hard work this semester. I know it's been, it was quick. It was hard. We had 2 chapters each week, which that's a lot, yeah. But overall, I think that it went pretty smooth, given all of the circumstances. Yeah, of course, I would have rather have done this in person. I'm like the rest of you. I agree. But overall, I think it went pretty well. And I hope that I was able to at least help you in some form or way through all of this. Um, I, I want to say thanks for taking that mid-semester survey. As you can see, I made improvements to the class based off of your recommendations. A lot of you said you wanted to see exercises. I started to include those in each week, just like I did with the chapter 16 there that we see in front of us. So your feedback, I take it very seriously, and I try to improve the way I teach based off of that. I look at all of you as my responsibility, and so I want to see all of you pass. I want to see all of you do well. I want to see you succeed. I want to see you at graduation. You know, that's what makes me happy, right? And so I hope to see some of you at the next graduation. If not, I'm sure I'll see you at a future one. If you are taking 202 with me, that starts next week, so I'll see you there. If you're not, hopefully I'll see you next semester. You could register with 202 with me for next semester. I imagine I'll be teaching it. The schedule hasn't come out yet. I think that'll probably be released next month, is my understanding. So be on the lookout for that. And otherwise, if you have LinkedIn, please feel free to connect with me there. If you're looking for job opportunities in accounting, definitely reach out to me. I'll be happy to put you in contact with some of my connections.
Professor,
Yes,
about that, I actually sent you an email, but I didn't get a response yet.
can you resend it, please? I
Okay.
I didn't see it.
Okay, I will.
Thank you so much. I appreciate that.
Thank you.
Hey, my pleasure. So yeah, connect with me on LinkedIn. Let's stay in touch. If you have a business opportunity and you're like, oh, I wish I could talk to somebody about this part of accounting, reach out to me. I'll be happy to answer any questions. Um, you know, I want you to look at me as a lifelong resource. Someone who's going to be there to help you whenever you need it. So. I really appreciate all of you. I appreciate everything you've done throughout the term. I want you to all to definitely stay with me. Adia, the question you're asking is, what is an extraordinary business? Are you
Yes,
referring to extraordinary expense or extraordinary? What do you mean by that?
oh, this one of the question that say extraordinary business like um maintenance business maintenance machine. Is it
Oh, okay. Yep. Good.
uh
Excellent question. So, an extraordinary expense or an extraordinary capital expense. So, the word extraordinary means that it will extend the useful life of the asset. So, extraordinary repairs and maintenance, for example, if the repair extends the useful life of the asset, then it is called an extraordinary expense. And what that is it extends the useful life. An example, let's say we have a dump truck, and that dump truck needs an oil change. That's just repairs and maintenance expense. Or let's say we have a building that needs a roof replacement. That if we replace the roof on a building, that is called an extraordinary business expense because it extends the useful life of that building. But if it's just like painting a wall, then it's just a regular repairs and maintenance expense. Does it help? Does it help to clarify it?
Yeah, how about the dry cleaners, Professor? It's not, right?
No, that's just regular repairs and maintenance. Yeah.
Oh, okay. I got you. Thank you,
Yeah.
Professor.
You're welcome. Yeah, great question.
So, Professor, I have a quick question again.
Sure.
How we identify like this business going to survive or
Yeah, good
if
question.
uh-huh.
So, how do we know if a business is going to survive or not? We look at a couple of different factors. One is, do they have enough cash on hand to pay their short-term liabilities? I would look at the what we call the quick ratio or the current ratio to understand if a business has the ability to survive.
Mm,
Good question.
okay. So, is there any like dry cleaners business, Professor? Is there any minimum like ratio they have to make, or it depend?
It depends. Yeah, that's a good question because with dry cleaners, if there is an industry, um, we call it industry average. If you search on Google for industry average quick ratio for dry cleaners, it might show up with something, and then you calculate the one for your company, and then you compare it to that industry average. That's one way of doing it. But the best way, the quickest way, is to simply do the current ratio. So you take the company's total current assets divided by the company's total current liabilities. If that ratio is greater than one, the company's in good shape. If it's less than one, but it's like zero point 0.8 or zero point 0.9, then the company will need to generate some additional uh, cash to survive for that next year. It's a good question.
Okay, thank you, Professor.
You're welcome. My pleasure.
Hey, Professor, this is Mr. Mark.
Mark, yes, sir.
Um, I want to say thank you. This is just me personally. Um, I'm saying thank you for taking the time out of your busy schedule to have that one-on-one. I do appreciate that so much. You've made me understand the whole aspect of accounting. Also, I will see you in the spring of 2022. So I
Awesome.
have to go because I have a doctor's appointment at 2 o'clock. So I'm gonna try to make that. So
You know,
I just wanted to say thank you so much.
it's my pleasure. Yeah, that's why I do what I do. You know, you all are the reason why I teach. Okay, my goal as a professor is to provide you with the knowledge that I have to enrich your lives. I try to make accounting as relatable as I can to all of you because eventually you will have some interactions with accounting. Whether you do it directly or indirectly, you will have interactions with it. And, you know, the idea behind it is I'm trying to improve your lives by providing you with the knowledge that I have on this topic to make your lives better. And seeing you all succeed is the reason why I do what I do. You know, that's the reason for my existence is simply to do all this. And you know, so thank you, Mark, for saying that. I appreciate that. And again, you ever need anything along the way, I'm always here. Feel free to email me, call me, set up office hours, whatever it takes. I'm here for your success. And as always, I want you all to stay safe, wash your hands, do the right things, and I'll see you all again sometime soon in a class near you. Thank you all so much. Take care, y'all. Bye bye.